Aditya Birla Fashion and Retail gains over 10%, now 14% higher after it says it will evaluate the potential demerger of Madura Fashion and Lifestyle businesses, which owns brands like Louis Philippe, Allen Solly and American Eagle, into two separate entities. After the completion of demerger, the company plans to raise growth capital within the next 12 months as well.
Hero MotoCorp slumps as its total sales fall 5.6% in March, despite an 87% growth in exports. Bajaj Auto reports a 25% growth in total sales. The management also tells CNBC-TV18 that sales continue to outpace the industry and exports will do better in FY25.
AC makers Voltas, Symphony, Blue Star, all of them gain in anticipation of higher demand as the IMD predicts scorching summer this year.
Bharat Electronics rallies close to 3% as UBS and Jefferies both are bullish on the stock. Data Patterns as well is up close to 8% after Jefferies initiates coverage and sets a target price of 3,545 rupees a share.
Aditya Birla Capital surges as Macquarie initiates coverage with a target of 230 rupees per share. The brokerage is expecting a potential re-rating on the back of expansion on return on assets.
Hello and welcome to Chartbusters. I'm Naishul D'Souza. Joining me as always is Mangalam Malu. Well, Mangalam, a quiet start, but after yesterday's big rally, I guess it's par for the course. The Nifty is oscillating between this 20-30 point positive band to a negative band. So I think pretty okay. And the broader market's still doing well.
Nothing really to worry, Nigel. You know, given the sort of macro cues that we got overnight with the US yields rising, crude prices rising, the dollar strengthening as well, one would have thought that maybe there is some bit of, profit booking on the cards. And in regard with that, we've actually done a lot better than what was anticipated, still holding around the 22,430 mark. The broader market's doing a lot better. The Nifty Bank doing a lot better gives one sense of confidence in the overall structure of the market itself. So let's get it straight to Apurva Seth for a quick technical check on the market. Apurva, two occasions in the last two trading sessions, we retraced a little bit from that, 22,500 and little above that mark as well. Do you see a breakout coming anytime soon, or do you sense that the market has run its course for the near term?
So a breakout might take some time, at least. So as of now, if you see the 22,500 strike has a strong build-up in call as well as put options. So until and unless we see some reduction in open interest around this particular strike, the market is likely to trade sideways, especially Nifty. However, the broader trend in Nifty remains positive. So one data point is that the first quarter of a financial year is generally the strongest, and Nifty has closed on a positive note in 8 out of last 10 quarters, and the average returns for the last 10 years in the first quarter of a financial year is 5.8%, which is highest. So April and May, and in fact we have election results in June, so until then we see that the markets are likely to do well, and we might even touch 23,000 levels in the short to medium term.
Okay, all right, sounding quite optimistic. The seasonal factors playing out, you're saying normally it's a good start to the fiscal year, and also you're talking about 23,000. Got that. But tell us more. What about individual stocks? What are you tracking?
So from the banking space, we like HDFC Bank. So it is currently trading around 2.5-month highs. So one can go long on HDFC Bank with a target price of 1550, 1600, and with a stop loss of 1450. And another one is HG Infra Engineering. So one can go long on HG Infra with a target of 1100 and 1150 and stop loss of 1000 rupees.
Right. Thank you, Apurva, for joining in and giving us your views on a lot of individual stocks and the indices on the whole. Wish you a good trading week. With that, we'll slip into our special segment where we get you a few ideas from our colleagues at Money Control Pro. These are ideas for profit. This one comes in from Khushbu Rai.
So today's idea for profit is Hindustan Liver. The company saw subdued volume growth for last many quarters. While some green shoots were visible in the December quarter results, the rural recovery remains slow and will depend a lot on policy support after the general elections and the fading El Nino effect. That said, HUL's reasonable presence in value-added bucket and premiumization would continue to drive earnings and market share growth. We expect the margin profile to remain strong, supported by benign raw material cost and the pricing effect for premium products. In terms of recent development, The announcement of the demerger of ice cream business by parent Unilever is a key factor to watch out as HUL is evaluating various options for its India ice cream business, which contributed 3% of revenue in FY23 and includes brands like Quality Walls, Cornetto, and Magnum. If we look at the valuation, the stock is trading at 40 times FY26 estimated earnings, which is below its 10-year average PE multiple of 50 times. We believe the investors can accumulate this stock considering the double-digit earnings growth in the last 4 years and strong return on capital employed of more than 25%.
Right, Khushbu, thanks a lot for that. That's about HUL. In fact, this morning we got a note from Motilal Oswal as well. They said that it's time to increase allocation to consumer staples. HUL has been underperforming. Let's see whether it turns out to be an idea for profit in the near future or not. But take a short break. On the other side, we have the management of Infa. Subrakant Panda, who's the managing director of the company, joins in to discuss about the company's business outlook, more importantly, the dividend that they announced.
Agreement that they've announced explains why that stock has popped up a little bit. I think it was trading in the red at the start of this hour. It's moved to the high point of the day as we speak. But as promised, let's get going with our chat on Infa. Mr. Subrakant Panda, who is the managing director of the company, joins us on the show. Hi, Mr. Panda. Good morning and thanks so much for joining in. Well, there are two pieces of news that we need to address today. One is you've thrown out a sweetener for your shareholders and given them a big dividend, so they'll be happy about that. And the other one is your diversification plan. Let's take the dividend first out of the way. Now, the total dividend payout will be around 81 crores approximately. So post this dividend payout, what is effectively the cash in books? Point number one. And also the total quantum you had to receive as compensation for that Utkal C block was around 350-380 crores approximately. You have received around 131 odd. How much is pending and by when we'll get it?
So, Nigel, this has been a long-running saga, and I'm glad that we have at least got the first tranche in the kitty. And as you correctly mentioned, about 131 crores has been received. And what that means is that the balance amount which we are entitled to get as per the final compensation order is roughly another 221 crores towards land, and mines infrastructure will be somewhere about 18 to 20 crores. So all in all, about 240. So what had basically happened was that the new LOT had challenged the final compensation order, and what the nominated authority has decided to do is to release the undisputed amount, which works out to 131 crores. But we do expect the balance amount to also come in soon, for the simple reason that the tribunal has refused to give any stay on the final compensation order. And that is why we are taking it up with the authorities, and we do expect it to come into the kitty soon. Now, the specific questions that you asked in terms of the balance sheet position post the special dividend. So cash in the books would be we are in a very, very strong position, fortunately. So cash in the books is about 350 crores, and undrawn working capital limits beyond that. So as I have been saying repeatedly that, we have a very strong balance sheet, and as we embark on our expansion and diversification plans, we are in a position to do that practically without taking on any debt. And, this is, of course, an ode to the hard work over the years and the strength of the fully integrated business model.
All right, Mr. Panda, congratulations on receiving at least the first tranche of the money, and shortly the second tranche would come about as well. I remember us having a conversation for every quarter. We'd keep asking about this. In the last conversation we had as well, you said the next time we speak, there will be clarity on that. So good on you. But now the diversification, as Nigel pointed out, the dividend was one. The other part is the diversification itself. Ethanol business. I mean, what explains the rationale for a metal and ferroalloy companies to go into ethanol? And with the kind of investment that you've earmarked for this, what is the kind of return, asset turns or margins that you expect?
So, we need to understand why we're doing this. And, it is a diversification, but it is not something which is going to make a big difference in terms of either our management attention or, resources that we're looking to commit to this. Broadly, our Therubali unit has surplus land available as well as allied infrastructure, which, while we are producing ferrochrome in 3 furnaces there, we are not going to add any more capacity in Therubali specifically because of logistical disadvantage. And that's why our expansion plans, which is 2 phases, 100,000 tons coming on board by early 2026. And we already have the state government approval for the second phase as well, which we will take up subsequently. So all of that is coming up in Kalinganagar in Jajpur district, which is closer to the mines, which is closer to the ports, which is closer to domestic stainless steel capacity in Kalinganagar itself. So that is where we are looking at our ferrochrome expansion. So the idea behind looking at a small investment in ethanol was to really utilize the surplus land which is available as well as the allied infrastructure, because this is going to be grain based and we have the railway sidings and everything else to handle bulk material. Now, while we have taken board approval for about 200 crores, the project cost itself, including land which is already available with us, is roughly about 150 crores. And once you take land out of the picture, the actual outflow in terms of investment will be probably 100, 110 crores, which means the equity investment is minimal really. And so what I wanted to assure all stakeholders is that we have not forgotten that our core competence is ferrochrome, and that is what we are going to focus on. This is just a minor sideshow, if I can put it that way, to utilize the land and allied facilities, which is not going to either detract from management attention or require substantial investments.
Just a question, sir. This land that you had, since it was surplus, you couldn't find a buyer for it and maybe, realize some money?
So, this is interior Odisha. This is something that, I don't think there is anything that can really come up there. At one point in time, we were, of course, considering expanding our capacity there. But as I mentioned, the logistical disadvantage is such that it doesn't make sense for us to put up any capacity there. And, I think it is much, in terms of, what this project will give us, broadly, we are looking at about, 200 plus crores in terms of turnover with an EBITDA margin of about 20%. So I think that's a much better option for us as opposed to looking to sell the land.
Just to clear this in, sir, you're going to be putting down 200 crores as an investment. The asset turn will be around 200 crores per annum with margins of around 20%. Effectively, you're doing the similar margin. So it won't be margin dilutive at all. In fact, it will be at par with what you're doing.
Not at all. And in fact, the project cost is probably about 150 crores. And if you take, which includes land. So if you take that out of the picture, the actual outflow in terms of investment is maybe 110, 120 crores. And the equity component is a fraction of that. So really, nothing substantive either in terms of, the resources that we are committing or management time that is going into it.
And by when does this happen? The 200 crores is from FY26 or FY27?
So we are looking to start construction sometimes later this year. One of the reasons for also applying before March 31st is that there is a special dispensation where you don't need environment clearances, etc., for green projects if applied before the financial year end deadline. So we're looking to start construction perhaps, I would say about 5 to 6 months' time and roughly about 18 months' time.
So I guess it's an FY27 story as against an FY26 story.
Absolutely. And which is when our core expansion, which is the 100,000 tons per annum Kalinganagar plant, will also come online. And, just to talk a little bit about the fact that FY24 has been a very, very good year for us operationally. And we are generating the sort of surpluses that we need to have in place to focus on our expansion projects as well.
Just to follow up on the investment that you're making, about 110 crores equity x land, you expect an EBITDA margin of close to 20%
not equity,
crore
not equity. Equity will be, that's the total outflow in terms of capex. So equity will be a fraction of that.
Okay. So what does this do to your return ratios? Because, you get close to 40 crores in EBITDA in FY27 on a capex that you're making of close to around 110 crores.
That's right. So as I said, it's not something which makes a significant difference to our top line or bottom line. It's just something that we feel is better use of the surplus land and infrastructure which is available, as opposed to letting it either lie idle or as Nigel suggested is selling that an option. We don't believe so. So this is something, and again, as we mentioned in terms of returns, it is definitely going to be value accretive. So it's just a small sort of attempt to utilize the surplus land which is available without in any way losing sight of the fact that our strength and our core competence is ferroalloys, and which is exactly what we are focusing on in terms of expanding our capacity, which we are already sort of underway.
Just going by the numbers, it appears on a return basis, on a ratios basis, it could be actually better, this investment that you're talking about, because you're talking about 40 crores on an investment of roughly around 110 crores. Or we'll wait for it to come on stream, but as you're saying, it's a story for FY27. Getting back to the core business then, the ferrochrome business, when does this expansion go live?
So, what we have been indicating is that there has been a slight slippage in terms of getting possession of the land due to administrative issues, and obviously with elections and et cetera, that that sort of slows down things a little bit. So we are on track, I would say, to commission the first furnace in early 2026, and basically broadly have the entire capacity available for most of FY27. And from that point of view, we have already placed major equipment orders, which are the long lead items, and we expect to sort of kick off construction later this year post monsoons.
Okay, all right. So then your capacity will go from around 280,000 to around 380,000, right? Post this expansion.
That's right. So 284,000 is the current capacity. 100,000 is what we are adding.
And then post that, you're looking at adding further capacity.
Absolutely, yes. So after that, we also have state government approval for the second phase, which will be broadly another 150 to 200,000 tons of capacity. And all of this, of course, goes lockstep with our increase in ore output, because that is the starting point of the value addition cycle.
Got it. And, sir, with both these two expansions, that's the ethanol business as well as the phase one that you have planned, you'll continue to remain a net debt-free company? Internal accruals will be good enough?
Absolutely. As of now, with the forecasts that we have in terms of the next 2 to 3 years, we do not expect to take on debt. I think net debt-free is the better way to look at it, because strategically we may decide to take on a little bit of debt and balance that out with cash on the books, so as to have flexibility available with us.
Okay, all right. Mangalavan, we'll be looking forward to having a chat with you at the end of the quarter once you declare your quarter four numbers. But just directionally, it appears that quarter one could be better in terms of margins in comparison to quarter four. And I say this because I'm looking at the ferrochrome trends globally, and you export most of what you produce. And also coking coal costs have cooled off, and you're getting your chrome ore from your own backyard. So margins directionally in quarter one or the first half of the next fiscal could be better than quarter four?
That is certainly what it looks like. Do keep in mind a couple of things, which is that as far as the benchmark price for quarter one is concerned, that went up by about 8 cents. Net, we expect an increase in realization between 5,000 to 6,000 rupees a ton for prime product. But there is a little bit of cost pressure as well, because what you're referring to, coking coal prices cooling off, do keep in mind that we are consuming metallurgical coke, which has been procured 4 to 5 months ago. So we are expecting a slight bump up in terms of our metallurgical coke costs for Q1. Also, the renewable energy requirements are going up, so that will add a little bit of cost, as well as some maintenance activities, one-off maintenance activities that we are taking during end of Q4 spilling over into Q1. So all said and done, there's a little bit of a cost pressure as well. But net, we certainly expect to do better than Q4. And if I were to look at the first half of the year, and again, Nigel, you're aware that I'm wary about talking about anything beyond 6 months forward. But the first half of the year, I would say, looks good, because especially once the rate cut cycle starts happening globally, that is going to provide a boost to commodities. China is also sort of pulling out of its slump with the manufacturing PMI picking up beyond 51. So all signs point towards a good first half, building on what has been an exceptional FY24 operationally, because I'm glad to tell you that we have registered an all-time high in terms of outputs, about 2.64 lakh tons, 264,000 tons. Our ore output is at an all-time high. So all of this, is sort of setting us up very nicely for the coming year.
Okay. All right, Mr. Panda, always a pleasure talking to you. Thanks so much for coming in and clarifying on the dividend payout as well as the diversification plans. We have a date with you, post your Q4 numbers, and we'll get further clarity on that front.
Absolutely. Absolutely.
Well, let's move on then. Here's a quick programming note. CNBC-TV18 presents India Exchange, where market experts and industry stalwarts will collaborate in insightful discussions on India's economic path and the evolving dynamics of the Indian market. Don't miss out on this. Tune in to CNBC-TV18 on April 4th at 5:30 p.m. onwards. Welcome back. Well, the mid-cap index is doing well. Hindustan Copper's FY24 production numbers are out. The metal in concentrate production, that's up by close to around 11%. The stock has been running up sometimes 11% in a single day. In the last 12 months, it's up close to around 212%. So the pricing has been strong, and now the operational performance as well, fairly good. Let's discuss some stocks with you, though. A couple of defense stocks are in focus. So Upasana joins us to fill us in with more details. Upasana?
Well, first, let me start with BEL. The company has reported its FY24 provisional numbers, and sales turnover stood at 19,700 crores versus the guidance given by the company earlier, that is around 20,000 crores. On a Y-on-Y basis, we are seeing an uptick of almost 13.6%. Now, UBS has given a buy rating with a target price of 257. It says that FY24 sales guidance missed, but new orders are up almost about 74% on a Y-on-Y basis. Order book stands at 76,000 crores, and two-year order book guidance of 5 lakh crore looks conservative, is what the brokerage has said. While stable supply chain dynamics, working capital cycle and closure of large ticket orders in FY25 will remain key to the continued outperformance of the stock. Now next, Jefferies has written a note on defense stocks. It has initiated a buy rating on data patterns with a target price of 3,545 and even a buy rating on BEL with a target price of 260 rupees. It says that the global geopolitical tension and India's rising focus on self-reliance is fueling order flow and revenue growth for domestic defense companies. Government's focus on building country-to-country relations to promote exports is the icing on the cake, is what they say. Now, 2x growth in domestic defense spends in FY24 to FY30 should continue to drive stocks upside, is what the Jefferies has indicated.
All right. Thank you, Vamakshi. Thanks a lot for that. Let's also focus on another stock which is surging in trade after a brokerage firm upgrade, which has come in rather initiating coverage. That's AB Capital that I'm talking about. Macquarie initiates coverage on the stock. Abhishek joins in to tell us more. Abhishek.
Well, as you mentioned, Macquarie has initiated coverage on AB Capital with an outperformance rating and a target price of 230 per share. They say that it is the top pick in NBFC space for them, and the next big diversified NBFC story is of AB Capital. So AB Capital is poised to grow, shows strong growth as well as strong earnings momentum going ahead. So they expect ABFL to deliver an AUM CAGR of around 28% over the next few years. That would mean that their ROA would improve by more than 10 basis points, leading to an ROA of 2.4% for FY26. So they expect 17% VNB, that is value of new business CAGR over 24 to 26 for the insurance arm, which is higher than the 15% average for other listed peers. So valuations are subdued at price to book value of 1.5 times to FY25 and about 1.5 times price to embedded value for the insurance arm. There is potential for substantial re-rating of the stock, is what Macquarie has written in their note. Back to you.
Right, Abhishek, thanks a lot for that. That's about AB Capital up around 8%, surging away as we speak. But the big trigger that the market is awaiting next is the RBI policy, which is due to be announced on Friday, the 5th of April. Lata Venkatesh asked CNBC-TV18's Citizens MPC about what they were expecting from the RBI this time around.
Let's start the vote. The first question, obviously, what will the Reserve Bank do to interest rates? Well, let me start with you, Sonal. What's your vote?
Pause.
Pause. Okay. Samiran, your vote?
Yeah, pause on rates.
Okay. Shaumyo, your vote?
Pause. Pause.
Okay. Sajid?
Pause.
Dr. Sen, well, it's a pause all over. Your vote, Chairman?
Pause. We are all on the same
That's
page.
unanimous. That's unanimous. Let's see if there's any change in stance. Sonal?
Retain the stance.
Okay. Shamiran?
No change in stance for now.
Okay. Shaumyo?
No change in stance.
Okay. Sajid?
No change in stance.
Okay. Well, Dr. Sen, you think it's time to change the stance?
I would move to neutral. We do not know what's happening.
All right. Okay. Well, let me ask the more relevant question, perhaps. When do you guys expect the first rate cut? Sonal?
We expect August onwards.
Okay. Samiran?
We think it's starting October.
All right. Shaumyo?
October.
Okay. Third quarter would be again October, December. Okay. Sajid?
Between August and October.
Okay. Well, Dr. Sen, what's your vote, sir?
After August.
Okay. Okay, then it looks like at least for the current and the next policy, we don't see too much of a change. Status quo is, but plenty on liquidity that we will hear out from the Reserve Bank, especially with the bond inclusion. Thank you very much, members of the Citizens Monetary Policy Committee.
All right, so we'll wait by for that verdict then coming in there. For the time being, consensus is no change, but the tone will have to be tracked. We'll wrap up on this edition of Chartbuster. Stay with us. Trading Hour comes up next.